In this video, we're going to talk about how to make a multi-step income statement. Now, this video is a shorter version of another video on how to make a multi-step income statement. So if you feel like I'm talking too fast or have a little bit of hard time comprehending, feel free to check out that other video. So just a quick review. When we make a single step income statement, what we're doing is we're taking all the revenues of the firm, and then we're just subtracting all the expenses, and that's giving us our net income. But with a multi-step income statement, we're going to have different subtotals such as gross profit, operating profit. It's going to be a lot more informative when we as an investor or creditor are trying to evaluate the financial position of a firm. So what I've done is I've put together a list of accounts and then a multi-step income statement for those accounts. And I just want to talk with you through those. So here's our list of accounts. And this is not a trial balance, it's just a list of accounts I put together to make things a little easier for you. And all of these things here will belong on an income statement with a couple of exceptions, and I just want to keep you on your toes. Dividends, for example, do not belong on an income statement. Remember, dividends are not an expense. So we're not going to have dividends in our income statement. And then also unearned revenue, even though it has the word revenue in it, is a liability. So it belongs on the balance sheet, not on an income statement. But all of the other items that we have here are going to be presented in our multi-step income statement for our company edible pizza boxes. So we're going to have a company where we've done some research and people are still hungry after they've eaten a pizza, and so we make pizza boxes that are actually edible and people can eat them. So that's our wonderful company, and we've got our multi-step income statement for the year ended December 31st, 2018. We're going to start with gross revenue, gross sales. And why do we say gross? Well, gross just means before net, right? And so what are we netting out? Well, sales discounts and sales returns. So if we gave some sales discounts or we had some returns during the period, we're going to subtract those out to get our net sales revenue. And once we have the net sales, then we subtract out the cost of goods sold to give us gross profit. And gross profit, remember, this is just a subtotal. This is just a subtotal. This is not an actual account of its own. It's not something you debit or credit. So that's a subtotal. And then we're going to go and look at our operating expenses. And so we've got selling expense, general administrative expense. Those are sometimes put together and called SG&A. So we got SG&A. And then we also have rent expenses, almost always categorized as an operating expense. So our operating expenses are deducted, they're subtracted, all these expenses here are subtracted from our gross profit in order to give us our operating profit. Our operating profit, which in this case $136,200. So again, we got what the net sales, then the deducted cost of goods sold to give us gross profit, then subtract the operating expenses to get operating profit. And then we're going to have a section where we have what are called non-operating items. So these are items like for this firm, we've got interest, revenue, and expense. We just put together an interest income, just net them together, or you can present them separately. But this firm, since we make edible pizza boxes, interest, revenue, and expense, those are not part of our core operations. If we were a bank, it'd be different. If we were a bank, our interest revenue would be up on the top line because that's the main way we make our business, our money. That's the main source of operations. But we make pizza boxes and sell those. So interest, revenue, expenses, they're not operating items, and so they go in their own little separate section down here. And we also have an asset impairment, so we had to reduce the value of one of our assets, and that's usually a non-operating item. And so once we have, the interest income is actually a positive here, and then we're subtracting the impairment. After we do that, we get income from continuing operations before income tax. Now, the reason we call it income from continuing operations is because we have a discontinued operations. There is a segment of our business that we decided to sell off. And because we're selling that off, we're going to have a separate section of discontinued operations. But we'll get to that in a minute. We've got our income from continuing operations before income tax. Then we need to know our tax rates. We assumed it was 40%. So multiply 135.9 times 40% equals $54,360. That is our income tax expense. and then that yields income from continuing operations. If we didn't have a discontinued operation, we'd be done. This right here would be net income. But because we have discontinued operation, we present that next, and then we do net income. So our discontinued operations, we're always going to have two parts to discontinued operations. One is the profit or loss of that division that we sold. And let's say we sold the division that made edible grocery store bags. We sold that off. That was a piece of our business. So that division itself had income or loss, right? And so the income was $29,000 from that. So that basically the grocery bag, edible grocery bag division had a profit by itself of $29,000. We multiply that by 1 minus the tax rate because discontinued operations are presented net of tax. Why? Because we already took out tax expense, but we didn't do that for our discontinued operation. So we presented net of tax, and that's $17,400. But then we also have a gain or loss on the actual sale of the division, right? So we've got our profit that the division had or loss. In this case, it was a profit. And then we have the gain or loss on the actual disposal, on the sale of the division. And so that gain is $2,760, and that also is presented net of tax. And that gives us our net income of $101,700. And you see, we have a lot more information here than with the single step income statement. We're not just laundry listing revenues and expenses, we're actually breaking them out. For example, we have our interest revenue as part of this interest income. That's in our non-operating items section. And then we got this asset impairment in the non-operating. So if an investor was looking at our firm, they could say, hey, wait, this type of expense, this asset impairment, I don't think that's likely to happen again next year. So then they could just kind of factor that out when they're trying to predict what net income will be next year. And so that's a really nice feature of the multi-step income statement compared to the single